Well, I'm delighted to welcome everybody here this afternoon for hopefully what will be one of our, I suppose, final virtual budget briefings before we eventually get back to a full physical one by next year anyway. And this year I'm delighted to have a range of experts on board who are going to wow you for the next hour with a load of information. They're going to examine the budget, see how it impacts you, how it impacts your business, but also we're going to look at it in a load of other ways. One of the other big challenges affecting businesses at the moment is in staffing, recruitment, retention in different areas. So Tony, Harney and James Nolan are going to take us through the first part in relation to the budget, a couple of different areas to do there, taxation, and a lot of the different measures. And then we're going to be joined by Joanne Foley and Nikola Aylward of Matrix Recruitment. We're going to examine it a lot more in relation to recruitment and retention and how it impacts you and your business in that way. So just to let you know as well that this session, it is being recorded. So once we have it all done at the end, by tomorrow, I would say tomorrow afternoon, we would hope to have it up on the website. So if there is any things you want to look back on, you'll be able to follow back on it. But after each of the presentations today, there will be an opportunity for you to ask questions. So for now, sit back. I'm going to hand you over to Tony Harney and enjoy the presentation.
Okay, on that basis, Brian, I'll try and share my screen. Have I rights?
Yep, you do.
Okay.
There you go.
Okay. All right, guys. In terms of running order, I'll spend a few minutes giving you something on the budget background. My colleague James will follow with the digging into the detail a bit more. And if we have questions at that stage, I think we should deal with them at that stage, because the discussion, the matrix piece around recruitment, it's of a different nature to the detail here. So I think it'd be appropriate to deal with the Q&A at that point. My first question there is, as between Jesus and Pascal, who's the socialist? Now, Jesus Christ has a reputation of being a socialist, if not a communist, but by my reckoning, he only ever advocated 50% tax. He said, if you have two coats, he says you should give one to the guy who has no coat. He didn't say you had to give both coats or one coat and a sleeve of the other one. But our government seems to be dead happy to take 52% from us, or indeed 55% on non-employment income. Not that anybody has too much sympathy maybe for lawyers, but our solicitor clients, our doctor clients who cannot incorporate their businesses pay income tax at 55%. And in fact, those guys are further disadvantaged because they don't have the same pensioning opportunities as people within companies. But I did a little calculation that for any of us, after we take home €555, we are taxed at high rate after that. And politically, like, where would you say the next move is it up or down? There is nobody within the Dáil advocating that tax rates come down, and certainly there's an appetite on the part of one side of the house for moving them up. The other fraud on taxpayers, as far as I'm concerned, is that when the Troika was around and when the government had to tax more and spend less, it gave an undertaking that for every euro it would tax more, there would be a euro it would spend less. It said the ratio would be 1 to 1. But you look at the announcement yesterday, the boast was that this budget, there'll be £500 million or so in tax givebacks in terms of what they did on tax bans and so on. There'll be about £500 million in that space, but there'll be £4.5 billion on the spend side. So when there were cutbacks, it was done on a 1-to-1 basis between tax and spend. And now that when we're going through the reversal of that, it's 9-to-1 in favor of spending. So draw your own conclusion in terms of where government thinking is and where democracy and politics drags it. And in a sense, in that same space, like, the background to all of this is borrowing and the level of borrowing. And And after those horrible Troika times and so on, like by the end of 2019, this country had a massive amount of borrowing in the amount of 200 billion. But at least it was getting no worse. The budget was balanced. In fact, there was a small surplus at the end of 2019. So the 200 billion wasn't getting any bigger. But then along comes COVID. And certainly you won't find me criticizing the government for what steps they took in the last 18 months. But what was done in the last period in the COVID context has added another 20 billion to what was 200 billion in 2020, and in 2021 another 17 billion. So at the end of this year, borrowing will stand at 237 billion. And the interesting thing for me is that if you read into the small print, the expectation is that will get up to 252 billion by 2025. So it's not as if they said, well, right, we had some manners on the borrowing at 2019. We had to do extreme things in 20 and 21, but now we'll try and get manners on it again. Instead of that, the trend is and the appetite is still upwards. I saw a lovely sentence in some of that small print on the budget stuff. It said, the government has used its balance sheet to absorb the pandemic-induced shock. That's civil service speak for we borrowed like hell in the last 2 years. I think Humphrey from Yes Prime Minister would be proud of that statement. The government has used its balance sheet to absorb the pandemic-induced shock. Is it too much borrowing? Well, in absolute terms, it's the highest in Europe. In relative terms, the question is, well, what do you relate it to? And there's an acceptance that GDP in an Irish context is kind of a meaningless concept. So we've invented this GNI, this gross national income, but since no other country uses that you don't get a measurable. So the ESRI have taken to measuring the debt in relation to total taxes that come in, and that you'd have to say that's kind of sensible, because it's from that total taxes that the debt can be serviced or repaid. Not much prospect of it being repaid. And on that basis, when the ESRI run those numbers, you'll see that Greece is the outlier. It has debt that is more than 5 times bigger than its annual tax take. You'll see that Italy is the next culprit, that Portugal is the next culprit, Spain is the next culprit, but interestingly, Ireland is the next culprit. So we are still one of those PIIGS that got a bad reputation some 10 or 12 years ago. I find it interesting that the frugal countries tend to be Protestant countries, and the profligate countries tend to be Catholic countries, whatever that says. And that debt servicing, I mean, we all know that we're living in a very low interest environment, so the government can service that debt, by which I mean just keep the interest paid on it. At the average interest cost to the government can borrow new money at about 0 at the moment, but because its bank of debt, if we call it that, has been borrowed over a period of time, so the average debt cost is 1.5%. So it takes 3.5 billion per annum to service that debt. But the government won't always be in that sweet spot. So if you were to imagine an interest cost to government of 5%, that level of debt would cost 12 billion just to keep the interest paid. And you get a sense of how big that 12 billion is if you think that the entire VAT take last year was 15 billion. So to take nearly all the VAT take just to handle that. I noticed Dermot Desmond was quoted in the Business Post on Sunday, castigating the government for renting houses rather than buying houses, renting houses from financiers at 5% per annum for the next 25 years. And by any measure, like that is a ludicrous tactic in a zero interest rate environment. But of course, the government does that because it doesn't have the capacity to borrow more money. Europe wouldn't allow it to take more money onto its balance sheet. So that's the reason it's forced into doing these, what I call stupid things, and what Dermot Desmond would call stupid things. So to my mind, there should be massive focus on debt reduction. But again, politically, there is not, because I suppose the budget is where economics meets politics. To touch on something a little more practical, I see yesterday the wage subsidy, which was going to end at end December, is now extended out to end April. In a sense, it's being tapered out to the end of April. It'll look fairly normal in January, February. It'll be down to max €100 per employee through March, April, and after February, full employers PRSI will be payable rather than the very reduced rate at present. The other thing I'd like to touch on, not at all touched on in the budget yesterday, but in the space of COVID type stuff, warehousing of tax is still out there for anyone who needs it. And to remind you, it applies to PAYE and VAT automatically for any company turning less than 3 million a year. It applies to income tax that we will be paying at the end of, say, in this income tax run between now and mid-November. In that case, you have to put your hand up and ask for it and explain that your income was down by 25%. But the beauty of it is that if you need it, you don't have to pay these taxes until beginning 2023. So you can roll them all up to the end of 2021, pay none of it through 2022, begin paying it at beginning 2023, pay no interest through 22, and pay interest when you do start repaying it at only 3%. So for those who need it, it's a great scheme. I'm finding that not many of our clients need it, thankfully, but for those who do, it's a great scheme. And all I'd advocate is, if you use it, be disciplined. Use it if you need to. Be conscious that you are carrying that debt, and don't use the spare cash to go off and give yourself that round the world trip that you thought the taxman always owed you. Just to touch for a moment on what we are seeing. Naturally, we have a view out into what's happening locally and a bit further than locally in terms of SMEs. And I'd express myself surprised by how few of our clients have been adversely impacted by COVID. And for those who have, the supports have been tremendous. And a few of those who have also benefited from loss of profits insurance. We have clients who have been positively impacted. I have a client who has been in the manufacture of cleaning chemicals and was able to branch into making hand sanitizers and make out like a bandit for the last 18 months. But clients other than that, because people saved up money, they didn't spend it on the things they normally spent it on, saved it up, and then when they get out, they get to spend it on different things. So some businesses have been positively impacted by the whole thing. As a generality, and this is very much a generality, but I would say SMEs, compared to any time since the financial crash, and like in terms of background, like we'll all understand that the two big things in this century have been the financial crash and then COVID. So everything is looked on in economic terms by reference to those. But I would say in general, SMEs are doing all right, thank you very much. So I would say they are in general profitable. They are in general generating cash, and they are in general sitting on cash. So they are cash rich and typically not borrowed. Where they are cash rich, so where companies have cash surplus, it begs nice questions as to, well, how do we get that cash out to ourselves? When do we get it out to ourselves? So those nice questions bring into play the use of pension structures, and the question: do I take money a step closer from my business towards myself by the use of pension structures, or do I build cash within the company? And if I build cash within the company, how do I get it out? So the discussion becomes around, well, build within the company, and then with a financial plan that down the line you'll be able to extract this money under the guise of capital gains tax, but with the benefit of retirement relief, and therefore getting chunks of money out tax-free, or with the benefit of entrepreneurial relief, getting money out with, at the cost of paying 10% capital gains tax. And there are worse things in life than 10% tax. Also brings into, if you go that route, it also brings into question how do you protect that cash in the interim? Are the structures you can put in place to keep that cash away from the risks of trading? The next leg of, if a business has surplus cash, the obvious question, and if it chooses to leave that cash, that money in the company, it begs questions around investment, and how you should invest that. And in terms of what should be the strategy for your company, I would say that there's no, what's the term I'm looking for? It's not a case of one solution fits all. It'll be really a question of, what's the best strategy for your company? So clients would ask me, should I use pension funding or should I build cash in the company? And when we run numbers, it depends on all kinds of things, including a discussion around who will spend the money, so that sometimes you conclude that, well, if you spend the money in your own lifetime, then leave the money in the company, take it out under the guise of retirement relief. That works best. But if you think that this money will never be spent in your lifetime, and in truth, this is money that will go to the next generation or generations, it may be that pension funding is the best outcome. For people who choose to build money in the company with a view to getting it out, they need to be aware that cash is treated differently from investments. So, for example, I can think of a client, a guy, say around 60, who is targeting building a fund of 750,000 that he would get out under the guise of capital gains tax retirement relief before age 66. And if he puts the question to me, well, should I invest that money? Because surely my money is going backwards. Inflation is at least 3%. And if my money is going backwards for the next 4 or 5 years, would it not be better off invested? And I said to him, go very carefully, because if you take it from cash and plonk it into an investment, it's treated very differently coming out the other end. So again, it depends on circumstances, and everybody should have the discussion around their own financial plan. If I can go back to politics for a moment, I think we all have a sense of which way the political wind is blowing, and I'm saying to my own clients, and would say to this gathering, that that whole space of the facility to extract money from your company, the facility to pass businesses on to the next generation, that the reliefs in that space are quite generous, and they might not always be there. Equally, I'd say the possibilities around pension funding, what I call directors' pension funding, the possibilities there to take lumps of money out of your company and into your own pension are quite generous. I have down there the pensions landscape and IORPS too. What I'm referencing there is that, to an extent, that space is seen as a bit of a Wild West by Europe, and there will be a gradual clamping down in that space. So I'm saying to clients, between a clamping down on the pension space and a changing political landscape, which could well attack the generous business reliefs in this space, I'd be saying to people, wake up. It might not always be like this, and act now while these generous reliefs exist. Don't take them for granted. Last thing I'll touch on before I hand over to James: 12.5% tax. Normally little to be said about it. Little to be said here. I'm sure to this gathering. I doubt there's anybody. I'd be impressed if there's anybody at the gathering whose business is turning more than 750 million. And if your business is not turning more than 750 million, 12.5%, as we have known it, continues to be the case for our companies. So with that, I'll hand you back to Brian and over to James to give you to flesh out the detail of the budget. I stop share, Brian, or you've grabbed me back. Yeah. Okay.
I've done it. Thanks, Tony. If there's any questions for Tony there, if you do, shout in there while James is getting set up. You just need to unmute.
Yeah, I think, yeah.
And otherwise, James, it's over to you. You can take it away there.
Yeah. Okay, you can all hear me. Can you all see that?
Perfect.
Perfect. Okay, doke. Thanks, Tony, for that. So I'm going to get into maybe a little bit of the nitty gritty of the budget after Tony's oversight. So this is what I'm going to look at. Tony mentioned already in his slides, but it's a little bit of a bugbear. The tax take comparison. Where are we as regards what individuals pay in Ireland as regards tax, particularly the margin rate of tax, and our compatriots in the OECD. I look at personal tax changes in the budget, business tax changes, capital taxes. That'll be very brief. VAT and excise. Looked at just 2 tax appeals that happened and the determinations were given the last couple of months, just to give it a bit of a taste as to what happens in the tax appeals court. And then the revenue commissioners, as I like to call them, our friends down the road, what their activity was like in the last 12 months and what their future plans are. And then I'll conclude on that. So I'll try and keep it to about 20 minutes or so. So this is something that we keep on touching about where we are in Ireland as regards our compatriots in the OECD and the marginal rate of tax. And Tony kind of touched on this as well. So in the latest comparison, we're 13th highest out of 36 countries. Only Slovenia is the top one at 61.1%, but in Ireland it's 52% or 55% if you're self-employed and your income is greater than 100,000. And I just noted there that, you know, COVID-19 has kind of put paid, I'd say, to any type of movement on lowering taxes for the foreseeable. This is just a chart I prepared just so that you can see where the tax takes comes from in Ireland versus our compatriots in the OECD. And you'll see that in this slide, Ireland is in blue, a bit like the soccer team last night. Ireland is in blue and the OECD is in green. But you can see the obvious peaks and troughs here and where we're different as regards outliers. So our taxes on personal income, the very first column, is considerably higher than the average in the OECD. But then come across to the third column and you'll see that the social security contributions are far less in Ireland than they are in the OECD. That's mainly accounted for by the fact that mainly across Europe, employers would pay a much higher contribution of social insurance than we do in Ireland. Kind of the other tax heads were quite comparable on. Okay, as regards changes in taxes for income tax, there is a new 30% relief, 30% of the cost of your domestic heat, electricity and broadband cost if you're a stay-at-home worker. Now, the only comment I make on that is that what happens if you're in shared accommodation or if you're not the bill payer? So if you've 4 people working from an apartment in Limerick that should otherwise be commuting to Galway and the landlord's name is on the utility bill, how do they get there? But yet they pick up the cost. How do they get that allocated? Or if you have a growing child at home working from home and you so happen to be the bill payer, how does that growing child get, or who gets the tax break on that? That doesn't seem to have been explained fully yet. So hopefully we'll see more about that in the Finance Act. And just a brief one on the Help to Buy scheme. Like a lot of these schemes, they're rolled over from year to year. So there's confirmations rolled on for one further year. But it will be reviewed next year to see whether it will be continued into the future. Basically, that's a scheme where buyers can get a clawback of income tax paid for a number of years to help as a contribution of a deposit towards the purchase of their first house. So a little table there just to show what we have as regards the differences between the tax credits. Now, for a long time, there's been no change in the credits, but so we see a marginal increase on the personal credit, so the married and single there, and you see an increase on the earned income credit. Very small stuff, but at least it's positive. But really, my own personal opinion, if the government wants to be fair to people, all these things, tax credits, tax bands, should increase with inflation. You shouldn't have to wait every 5 years for something above €50. It should increase by inflation if you want to be fair to the taxpayer. The tax band, so a slight widening of the tax band. So more of your income, if you're a high rate taxpayer, more of your income is going to fall into the low rate bracket, which is a saving of 20% of that uplift. So the difference there for a single person is 1,500, married one income again 1,500, two incomes married or civil partnership, it's 3,000, and single parent, it's an increase of 1,500. So if it's a single person, 1,500, 20% of that, 300 is the annual tax savings for a single person as a result of that. USC, I've thrown it all down there, but really it's the 2% rate is the only one that's changed. So slight widening of the 2% band. So you can earn a little bit more on the 2% rate, and generally that they tweak that band every year to tie that rate in with the average industrial wage and the minimum wage. PRSI, small little change. Again, it's a pushing out of a ceiling, so that there are two rates of employers PRSI. The high rate is 11.05. So they've pushed that higher rate out from 398 per week to 410 per week. So anybody who's on earning around those earnings amounts, they will not tip into the high rate of employers PRSI till their gross is over 410 a week. And I just threw it in again. This has been on the slides for the last X number of years. It's been promised since 2018 that they're going to merge USC and PRSI. But no mention of that, and no likelihood of it ever happening, in my personal opinion. This is just something that you should be aware of. It's kind of maybe a little bit historical, not to do with the budget, but it's as a result of the TWSS and PUP. So all employees would have received kind of a balancing statement early in January 2021 to identify any tax liability that arises on their doorstep as a result of PUP or TWSS that they may have received in 2020, and a preliminary tax calculation was provided to them on that statement. So they had an opportunity to look at that then and to make a payment to clear the liability in full, or make a part payment, or otherwise, if they do nothing now and let it sit and rest, they'll by default fall into a warehousing of that, where their tax credits will be reduced over 4 years, commencing January 2022, and the tax will be spread out over those 4 years and clawed back over those 4 years from their take-home pay. So if somebody owed 2,000, their take-home would fall by 500 a year for the next 4 years to pay that back. Business taxes, which I suppose is what we're really interested in here today in this forum. Tony mentioned corporation tax. It's no change to that. 12.5% for 2022. It's still 12.5% for everybody. It's set then to increase to 15% in 2023 as part of this global deal on taxation, but only if your turnover is greater than 750 million. And that was flagged well before the budget was flagged last week, or at least 10 days ago. And no change on the 25% corporation tax rate for passive income. So that's basically what corporates that have investment income, rental income, or deposit income, or such like. Other business issues then, so minimum wage, a small increase in the minimum wage. It's standing 10.20 since the 1st of January of this year, so it's increased to 10.50 from 1st of January next year. Tony mentioned it as well, employment wage subsidy scheme will remain in place in a kind of a graduate format, so it's been phased out and it's there till the end of April 2022, and it's closed completely to new entrants from the end of the year. So if you're in it, you're in it. If you're not in it, you only get to the 1st of January to get in. A lot of talk about this zoned land tax at a rate of 3% to encourage the use of land for the building of homes. Now, we already have a vacant site levy, so this now has been branded as a tax. The levy failed miserably. There's various reasons why it failed. It was a levy that was supposed to be assessed by the local authority. the local authority really would put their hands up and say they didn't have the resources to properly go after this. And the developers also played a little bit of silly buggers with it. But anyway, it's now a land tax. Basically, like LPT, it's been handed over to the revenue commissioners to tackle this and to collect it and to assess it. So generally, when things are handed over to revenue, they're very successful. It commences in 2 years' time. The time lag has been explained for the reason that they're giving developers the opportunity to get their act together in those 2 years, plus giving revenue the opportunity to gear up on this from an administration point of view and to do their assessments, review where all these land banks are, attribute valuations to them, and to also equate whether they are viable or not. So they need to assess them. So there's a lot of detail to be done there, but that's the reason for the 2 year time lag. There's a range of increases on VRT from kind of mid-tier cars of a 1% increase up to more expensive higher engine cars at 4% increase on the current VRT level that's already there with effect from 1st of January. And the old BES scheme, which is now the Employment Incentive Scheme, the EIIS scheme, that's been extended for a further 3 years. And some of the awkwardness that was in there is being removed, this 30% cap on expenditure, to encourage businesses to participate in it further, and to basically create a wider range of investment funds for the private individual to invest in. There's a possible, they didn't say for definite, but a possible extension of excise relief for independent producers of cider. I just mentioned it here because there's a few local establishments here well known for producing fine beers. So it's something that's of interest to independent brewers. And basically the relief that independent brewers, small independent brewers are getting on excise will be rolled over to those that are now producing cider. There is a relief, and it's been there for a number of years now, corporation tax relief for startup companies, where they're effectively exempt for tax for the first 3 years, subject to certain caps and ceilings. That's now been extended out to 2026, and the period of relief has been extended from 3 years to 5 years. So that's definitely of interest to new corporates. And then there's a new tax credit for those that are in the digital gaming industry. Probably not that broad an industry really, but for investment in projects for eligible expenditure up to 25 million to get an additional tax credit of 32% of that expenditure. There's currently a BIK exemption, so no BIK on electric vehicles if you're fortunate enough to be supplied one by your employer up to a certain value on the vehicle. That is going to be phased out, and there's a tapering effect being brought in between now and 2025, where a bit of BIK will be paid on that car, and more, and eventually a full BIK will end up being paid on the electric vehicle. It has to be a full electric vehicle. Hybrid does not comply with the rules. Full electric battery rechargeable vehicle. Tony mentioned the broad tax debt warehousing scheme. So there was a nuance there that if you were a proprietary director who was in receipt of POI employment, Schedule E income, your own employment from your own company, you weren't entitled to warehouse that. So a self-employed individual was, but a deemed self-employed individual who was a proprietary director wasn't. Now, they didn't use the language proprietary director in the budget yesterday, which is unusual. They said the scheme has been extended to individuals who have a material interest in their employer company. So we can only assume by what they mean there is the proprietary director, and that proprietary director is now going to be allowed to participate in the scheme. It definitely wasn't unfairness there for those individuals. There is currently a temporary waiver of commercial rates for hospitality, arts, and certain tourism industries in that sector. That has been extended till the end of the year, at least. No mention about next year, but it's definitely been extended to the end of the year, which is a benefit for people in that sector. And it looks like there's a pilot scheme being brought in, which is a basic income guarantee scheme for artists. So presumably that'll work through the social welfare mechanism. I don't have really much detail on it yet, but presumably it's a subvention where an artist can apply for a top up to their income, to bring their income up to a guaranteed minimum level, so that they can continue with their work and their arts. this was brought in a number of years ago before any pre-letting expense incurred by landlord wasn't allowed for tax purposes. So if I had a house and I wanted to get it ready to get a tenant in there, and I had to spend 3 or 4 grand to get it lettable, I didn't get any tax break on that 3 or 4 grand. I was only allowed to claim my expenses against rental income when the property became let. So in order to encourage landlords to get properties out into the rental market, they changed the tax law to say the pre-letting expenses up to a cap of 5,000 is allowable, tax allowable expense, and that has been extended now out onto 2024. Capital taxes, this will be very quick. So no change to the primary rates of CAT and CGT, they remain at 33%. No change to the thresholds. There are 3 thresholds depending on the relation of the beneficiary and the benefactor, and does not change there. So once you reach those thresholds, they're lifetime thresholds. Once you reach them, either in an individual event or an accumulated event, you pay tax at 33%, subject to various reliefs. And just no mention at all of CAT or CGT in the budget. And there are reliefs, Tony touched on them there, that are of interest to people in business: retirement relief, entrepreneurs relief, business asset relief. They're still there, but they didn't even mention anything about them. So we have to assume that they're there for the foreseeable, but we'll know next budget. VAT and excise, not much to say here either. VAT for the hospitality industry and tourism sector, it is currently at 9% instead of what it should be is 13.5%. So that reduction will remain there until August 2022, when that sector will revert back to 13.5% again. And a small kind of booking in the trend here, flat rate VAT rate for farmers has been reduced marginally from 5.6 to 5.5%. So a lot of farmers are not in the VAT in the VAT world. They're not registered for VAT, so they suffer VAT on their inputs. So in order to give them a break, they're entitled to claim this flat rate on their sales, even though they're not in the VAT world, they're not registered for VAT. So there's a minor reduction there, which I'm sure our farmer colleagues won't be happy with. Excise duties, cigarettes up 50 cents again. I think the minister said yesterday that makes a packet of cigarettes, average packet around €15, which is a huge amount of money really when you think about it. No change to alcohol, so no change to excise on alcohol, and what is now the old reliable, which is the carbon tax, and this has been earmarked from some time back now, that there will be a €7.50 per tonne annual increment up to 2030. That happened at midnight last night. So if you didn't fill your cars up last night, it's going to be costlier today. Just to briefly talk about tax appeal, it's just an interest sake. I throw it in. I look at these determinations myself because that's just the world we're in. But some of these are quite interesting when you see the cases that appear there. It's basically where taxpayers disagree with the taxman when he raises an assessment based on something that maybe is an unusual case or an interpretation of law or something like that. So there's a dispute between the taxman and the client on a piece of tax legislation and how they should be treated. And the taxman raises the assessment, our client or the taxpayer disputes it. So his first port of call is the tax appeal court. So here's an example of one that was found in favor of the taxpayer, which I thought was slightly unusual. It was only a very recent case. So the case concerned with 2 daughters who received 1.23 million in payments over a period of time, over a period of 4 years from their father. And money was just lodged straight into the daughter's joint bank account. And the proceeds of the money was from the sale of overseas properties that the father had accumulated over a period of time. So dad's properties, he sells them and puts the money in the daughter's bank account. Taxman identifies this, and how he identified it was he got a report from the bank detailing interest returned on those deposits, on those monies, and the daughters weren't returning those interest received in their income tax returns. So taxman came knocking the door saying, why is the taxman saying that you have deposit interest and you're not declaring it? And equally, if you have this deposit interest, what was the source of the funds? So when Revenue got into it and looked at it, they said, this is a gift from father to daughter. It's as simple as that. We want 33% of it, please. So they wanted 400K in tax, and they raised assessment for that. So the daughters rocked off to the tax appeal court, and they basically had nothing in writing, but they all gave evidence, and they claimed that there was an oral trust, that there was a trust in place between the daughters and father, and that the money was just basically, to use Father Ted's phrase, resting in their account. The money was at all times to the benefit of their father, and it was just in their bank accounts. And despite the argument made by Revenue, the Tax Appeal Commissioner accepted the verbal evidence given based on the circumstances of the case, and he agreed with the family. The assessment of 400K in CAT was reversed. One that's maybe of interest, and again, this time it's Revenue won their case. So case concerned Listowel Race Company, who run the race course in Listowel. They'd be the equivalent of Gorn Racetrack here locally. And they claimed that their activities were exempt from tax, for the simple reason that there is a piece of tax legislation that says that sporting bodies that promote athletic or amateur games or sports are exempt from tax. That activity is exempt. It's known as the sporting exemption. So the Revenue came in and they reviewed the affairs of the Listowel Race Company, and they claimed that the horse racing activity was an industry and that this is not a sport at all. So Tax Appeal Commissioner looked at it, agreed with Revenue, and the Listowel Race Company lost their case. So their only avenue now is to go to the High Court, and they've mentioned that they are going to lodge an appeal for determination in the High Court. With Revenue Commissioners, just very quickly, where they are and what are they doing. They issued their statement strategy for 2021-2023. They're the 5 topics that they covered. So COVID-19, they will continue to assist the government in rolling out funding, assessing funding, and all that type of stuff in relation to COVID-19. And of course, collecting taxes relating to COVID-19. They are looking at evolving the workplace for their own staff. So they're looking at that, how their staff are currently working, where they're working, and remote working. And they're looking at rolling out a strategy for that. Brexit continues to be a very live animal. They're looking at all aspects of Brexit and how it's impacting on tax collection and on customs and that type of thing. International tax, so they're going to be very much at the forefront with that increase in corporate tax and assisting the Department of Finance in calculating the impact of that and how the government will manage that. And then in compliance in general, they will continue to beef up compliance. That is their #1 aim at all times, get compliance good and strong on returns and on collection of taxes. And I think we mentioned it already, but I just put it in there because it's something that's out into the future. Revenue will continue to facilitate the warehousing of taxes, and particularly the TWS tax liabilities over the next 4 years. So I won't go too much into detail here. These are some slides of revenue interventions and audits. Construction industry is always their favorite, but you can see that because of COVID, not as many interventions arose in 2020 versus 2019, and as a result the tax takes and the yields on those fell. The one that's an outlier that's jumping out there is that despite the fact that it was 658 audits versus 1,084 for professionals, the take was actually more than double, and that was really down to some medical people that were audited in that year. If you look at the full activity and what came in from revenue activity in 2020, again, you'd say, oh, like a lot of the audits are down, but if you look at the mid-tier table there, risk management interventions and insurance checks, the activity there is actually up in number of completed events and also in the yields. And really a lot of that is to do with COVID checking and ensuring that monies that were received by employers or by individuals for COVID-related subsidies and funding, that was a lot of the checking there was assurance checking to ensure that the right people got the right sum, and clawbacks were done in cases where people were overpaid. So total interventions, when you look at it, actually balanced out. So I mentioned compliance a little while ago. We're actually not bad as a country. When you look at revenue activity, these are the 6 main tax heads. income tax for the first time ever, I think, we were 100% complied with their tax payment within the due month, which is amazing, really. POI, VAT, we're all up into the 90s, the high 90s. Capital gains tax is always a little bit on the low side because of the nature of people discovering there's a different payment date to that to income tax. As regards random audits, so revenue, even though they were at home, did more random audits in 2020 than they did in 2019. They completed 200 of those, and they got the princely sum of 2,124. A tenner an audit is what they received on average there. But really, when you look at it, there was only one audit out of the 200 that completed yielded anything. So one person paid 2,000, but on average, for all their effort, they got a return of 10 per completed audit. And then if you look at business activity and how business is interacting with revenue, no real surprise on the first two. Registered contract tax, RCT, that's really to do with the building game. There are other industries involved in RCT, but you can see that the activity there, so the number of contracts notified to revenue is down almost 11%, and the number of payments is also down 11%. So no surprise that the construction industry took a dip in 2020. But what amazes me is the other three. The number of POI employments in the country is 3.2 million, which was actually up 1.3% on 2019. So the number of employments in the country actually is up 2020 versus 2019. And equally, the number of self-employed individuals is up 2.3%, 2019 versus 2020. And the number of corporation tax registrations is up. So, I mean, the latter three has to be seen as quite positive. So in conclusion, just on the little nuances that happen with the tax credits and tax bans, it's very simple to work out. A single taxpayer will be better off by 400 per annum. High rate if you're a high rate earner, 100 per annum if you're a low rate earner. Social welfare, we didn't touch it in this, but social welfare recipients get a broad spectrum of increases. COVID-19 funding is on the way out, it's been phased out from middle of next year. There was significant spend across all departments, and Tony touched on that in his section. And just a little reminder, LPT returns, local property tax returns, the deadline is the 7th of November for anybody that needs to make a filing there. You need to get in, log on to your LPT or do your paper filing before the 7th of November. And what would I be scared of in the next short to medium term? 4 things: inflation, wage demands, political instability, and that's maybe global, you could say, and finally interest rate increases. There are 4 things that I'd be concerned about. I have to pick the 6 numbers for the lotto tonight, so if I get those 4 right, that's something. And just to finish on a little funny punchline for you, a fine is a tax for doing something wrong. Tax is a fine for doing something right. So remember that one. Thank you.
Thank you very much, James. Is there any questions there from anyone for James or Tony at this stage?
Yeah, James, can I ask, is there anything specifically that is coming up in the revenue audits that people are consistently making a mistake with or misunderstanding that can be easily resolved if we know in advance?
Yeah, no, Colin, there isn't really a pattern. I mean, revenue have invested down through the years hugely in their IT systems. And you'll see from the slide there how little they get from doing random audits. So if you're getting an audit, you're getting it for a reason. And you're getting it because of the financial data that was submitted in your income tax return or your corporation tax return, and that there's some outlier, there's some flagging in there, either that when they compare your activity or something in your financials to a previous activity of or a previous period, and something is bucking the trend there, or they're comparing you to your industry and something is bucking the trend there. They're the main reasons why you would be selected. Alternatively, they're doing kind of industry type audits. So they would say, we're going to do all chip shops, and we're going to do all the chip shops in Wexford first, and then we'll see what we learn from there, and then we'll do the chip shops in the rest of the country, or we'll take a lazy way out and we'll do the €1 audit where we find out what's going on in Wexford, and then we send all the other people just a letter saying, we know what you're up to, come clean and send us in a voluntary disclosure and pay your tax. They're the €1 audits, and they're a great return for money for the taxman. But people, like, if people are making silly mistakes that are outliers that are resulting in revenue audits, the silly things are being late with their tax returns, being late with payments, simple things like that. Just bring you to the attention of the taxman, and it's foolish if you can avoid that at all costs, avoid it. Other than that, revenue audits mainly we would see would come because of unusual or once-off large transactions, exceptional transactions, or booking in trends of something or other, that there's a change in someone's pattern that results in revenue coming to see what's going on here. Yep.
Thanks.
Thank you. Any other questions there? Otherwise, I would like to hand you over to Joanne Foley and Nikola Aylward from Matrix Recruitment. We're going to very much focus on recruitment and retention, which is a key area and impacting a lot of businesses at the moment in a number of ways. So if you want to take over there, Joanne.
Yeah, absolutely. So good afternoon, everyone. Thanks very much, Tony and James. That was really informative. Tony, I think I'm going to have to remember that Jesus and Pascal analogy for future. I like that one a lot. I guess there was nothing specific in terms of attracting or retaining staff in this budget. And I attended the National Recruitment Federation breakfast briefing this morning as well, just in case they had noticed something that we had missed. But the only thing that they referred to really there was the income tax relief for remote workers. And I know James touched on that as well. And I think perhaps it raises more questions than answers. But the one thing I suppose that came out of that then was that the e-workers allowance is something maybe that prospective employees might be looking for, and that might be a question they'll be asking. Is that something that a prospective employer will be providing? However, even though there was nothing specific in the budget, as we're all aware, we are facing huge changes in the employment market. There's a very high employment rate in Ireland at the moment, and unemployment has fallen under 10%. So it's very much a candidate-driven market, and there's a war for talent, and that's across all sectors. Whether that is, obviously the ones that are getting a lot of media traction, such as retail and hospitality, which obviously were very heavily impacted by COVID. I mean, I think if we walk into any retail store or restaurant at the moment, you'll notice a sign up saying that they're hiring staff. Similarly, the trades sector, that's one that everybody's aware of as well. Very, very hard to get people in that area at the moment. And it's across all sectors, really. We're noticing it across all sectors, and that be it multinationals or SMEs. Again, there's a lot of talk about the Great Resignation, and that in particular in the US is something that we've seen there. In the month of April alone, I think about 4 million Americans quit their jobs, which was a record number. Where we're not experiencing quite that level of resignations and people quitting their jobs here, two very different Irish studies have shown that almost half of the Irish workforce do intend to change their jobs within the next 12 months. So that is something to bear in mind. Also, post-COVID, we're noticing a change in the hiring process. So there's positives and negatives to this. The positives are that, because during, lockdown, if you needed to hire somebody, you needed to streamline your process. So out of that has come a quicker, more streamlined process. There's not as many sort of rounds of interviews per se. People don't have to go on site for as much. Obviously, we've had the advent of, Zoom, like we're here today, and MS Teams, and they're being used for interviews. So that's really, really good, because candidates are finding it much easier to attend interviews. They can do it, do an interview, before work, or maybe at their lunch break, or after work. And equally for prospective employers, it's that bit easier as well. There's not as much toing and froing trying to find suitable times for candidates. And then, lack of, having to book a meeting room or whatever, you can do the interview at your desk. And you can use Zoom or MS Teams for the first round screening interview, and then potentially second round, bring the person on site, when you've narrowed down to maybe 2 or 3 potential candidates. So certainly that has, helped in streamlining the interview process. I suppose a cautionary note is, of course, for your current employees, they are finding it easier to attend interviews, and you're not seeing that, those typical red flags of people booking these random half days here and there. They could be doing these interviews on their lunch break, or maybe even while they're working from home. So that's just something to bear in mind. And I suppose now that people have more remote and hybrid options open to them, again, that's giving access, in some ways to a wider talent pool, because you're not being as restricted by geographical location. And people are willing to do maybe a little bit of a longer commute, 1 or 2 days a week. So whereas before that area might have been out of their scope, because they weren't going to drive 5 days a week, now maybe, they consider doing that 1 or 2 days a week. So that is opening it up in that regard from a geographical perspective. The negatives with it, obviously it's very much a candidate-driven market. People want to keep their employees if they can. So there's a huge amount of counter offers happening. So that's when somebody goes to their employer to hand in their notice to move to another company. The employer says, "Oh, hang on a second. We want you to stay. We're going to give you X amount of money. You can work from home every day if you want," whatever it is. And candidates are accepting that. So that is definitely something that we've noticed a lot over the last number of months. Obviously then as well, the candidates have more choice. So they're getting offers from competitors as well. And it's just some tactics, I suppose, being employed there are things like a signing on bonus. I've seen some companies who are offering maybe 3K signing on bonus for people. And then equally, people are being offered retention bonuses to finish out a contract. So that could be something like maybe 20%. The other element, I suppose, as well, is then that candidates are actually being paralyzed by choice. They don't know what to do because they have so much choice open to them. And I was chatting to somebody recently, and they were making the point that companies want to find this perfect candidate, but and during the recruitment process maybe they feel that they've found this perfect candidate. But just to note that a candidate is only perfect if they accept your job. If they haven't accepted it, they weren't perfect. They weren't right for you. And it's just, I suppose, not to get, hung up on this one candidate during the process. And it's just something to be aware of when you are recruiting, that, maybe the first person you offer the role to won't take that. So always have, somebody else there as well, a backup person that maybe does want to take the role. And then they are actually your perfect candidate. Hiring from abroad, again, this is something that we discuss a lot with our clients. The process, I suppose, it is something obviously we have to look at the moment because of the candidate and skills shortage here at the moment. So for candidates who can move freely and work freely here from the EU, virtual interviews again have made that process that bit easier. We've hired a number of people in Matrix, for our clients over the last number of months from the EU, and the process was, first, second round interview via MS Teams and Zoom, and then once the travel restrictions were lifted, the candidates then came to Ireland to go on site to meet the employers, get a tour of the plant, etc. In fact, interestingly enough, the one stumbling block on one of the hires was the lack of accommodation in the southeast. It did get sorted in the end, but that was actually the most difficult part of the process. Obviously as well, then we have had 1 or 2 candidates who were hired and based in the EU, and they actually started working remotely from where they were in Europe. And then again, once travel restrictions, etc., were lifted, they were able to relocate to Ireland to join the company. Then obviously outside of that, then for non-EU candidates who require a visa, that process, as I'm sure most of you are aware, can be quite time consuming, but it certainly can unlock a lot of untapped talent. And there are a number of people, already here in Ireland who are on a visa. So for example, if people come here and study after a bachelor's degree, they can work for a year on a 1G visa without restrictions. And then if somebody does a master's or a PhD, then they can work for 2 years. And then obviously, there are critical skills visas as well for those sectors that the government have identified as requiring people to come. That process can be a bit more time consuming, but sometimes it can be essential. And very interestingly, I read an article recently about Amazon. So they have 4,000 employees here in Ireland at the moment, and they issued, I think it was just over 400 visas to non-EU nationals in 2021, and that's the highest in the state. but certainly it is something that employers do need to look at. And as I mentioned already, accommodation can be a real issue, not just for people relocating to Ireland from abroad, but even if somebody wants to relocate within Ireland, somebody needs to move county to take up a role just because of the current accommodation and housing shortage. So I suppose the main question then, not as Mel Gibson would ask, what do women want, but what do employees want? So certainly over the last 18 months, people have been, taking stock of what's important to them. It's been the great reevaluation. So, during the pandemic, job security was very, very important. And what's come out of this now, as people are, returning back to the offices, etc., is, millennials make up more than half of our workforce at the moment, and they expect more from their employers. So whereas before the differentiator oftentimes was around salary and benefits, that has changed, and really the key now for people are flexibility and the whole work-life balance. And really, if you want to attract and retain your staff, you need to be offering some form of hybrid working. That is key. And that is good news for SMEs, and I'll touch on that in a minute. We in Matrix conduct an annual workplace equality survey every year, and in our current report, which was released last week, 85% of respondents said that they would like a 4-day working week. And more than half of workers were concerned that choosing remote working would create inequality. With regards to the budget then, we have noticed that there have been some provisions around childcare and parents' leave. And again, that links into our equality survey, which I think about 40% of respondents said that, they noticed during the pandemic an inequality between those with children and those without. So while those measures, aren't going to fix that by any manner of means, they may address that somewhat. The other element that people really, again, are looking for is that company culture. They want to feel a sense of belonging. So they want to feel that their employer is, looking at people first and seeing them as employees second. Again, around, during the pandemic, there was a lot of rhetoric around essential workers and frontline workers. And I think from that, people really want, that sense of purpose in their role. They want to feel that, they're contributing to something. And I know that, for example, pharmaceutical companies in general are very good at doing that. So whether you're on the production line or, you're a director in the company, what your role is within the organization and how it contributes to the overall goal of the company. And they're really, really good at promoting that. And I think this is where, SMEs can sometimes find it hard to compete with multinationals in terms of salary and benefits, but they can provide that. An SME can provide somebody with a sense of purpose and a sense of belonging, probably sometimes more so than multinationals, because you can contribute and see where you're contributing to the company. You're more than just a number, and I think that can be a real differentiator at the moment for SMEs. Whereas sometimes it can be that bit more difficult to compete in terms of salary and benefits. And equally then with regards to flexibility, remote working, work-life balance, again, that's something that can be provided by SMEs and can certainly compete with the multinationals on. With regards to salaries then, our 2021 salary guide did see an increase in salaries pretty much across the board. We are getting ready to release our 2022 salary guide, which obviously we can share with you guys once we have that ready for release. And I suppose the key element really coming out of all of this is communication. Communication is key for employees and employers. Everybody, I suppose, everybody's priorities have changed. People have different perceptions of how things should be now. Employees have, established maybe a preferred or a new way of working. So what we need to do as employers is talk to our employees, find out what their expectations are, maybe what are their concerns, what are they expecting, what do they want going forward, what's going to work for them. And then equally, as an employer, you need to talk to your employees and explain, the business needs and what will work for the business. And really it is to to find a balance there and to find what will work. But certainly uncertainty is the worst thing that can happen here. So definitely, you know, one-on-ones, chat to people. Everybody's circumstances are different. Everybody's expectations are different. So it really is about talking to your employees and then seeing what's going to work for you going forward best. I'm now going to pass you over to Nikola. She is going to talk around the retention of staff and what these new working models will look like.
Joanne, one of the things you mentioned there was that the lack of accommodation in the southeast as being a barrier to bring people in. That doesn't seem to be repairing itself in our the budget presentation we see from yesterday. Where do you see that as being, how to remedy that in the future?
I'm not sure how, you know, I mean, I suppose that's something that the government is definitely going to have to look at, you know. I suppose, as I was saying, you know, this is where maybe, you know, remote and hybrid working models can assist somewhat, you know, over the next period of time, you know, that if somebody cannot physically relocate, that maybe if the role, of course, can be done from home, that then maybe, you know, that's how that person is employed by the company. And I think, you know, the pandemic has forced us to look more at remote and, you know, hybrid models. So that is, I suppose, you know, maybe a short-term fix at the moment. Now, we did get the situation that the person in question did actually manage to find accommodation. It was actually easier for them to buy than to rent long-term. So they decided to go down that route. But it is something, you know, when we're chatting to candidates, it is something that they're, you know, struggling with when they're looking to see what sort of accommodation, particularly short-term accommodation, you know, while they get settled or whatever, is available to them. So I suppose that maybe is where, you know, remote, I did mention we did have another candidate coming from Europe who, until got accommodation stuff sorted, actually worked, you know, from their country in the EU until they got accommodation sorted and then relocated here. It's by no means perfect, but it could be a short-term fix.
Thanks.
Joanne, you've got the next bit as well. Nicola's having problems with her audio.
Okay.
So have you got the slides there, or?
I do indeed. Yep. Just give me 1 second now and I will reshare my screen. Okay, so as I was saying, you know, I was talking a bit about the attraction of staff. So then once you attract them, or obviously given your current employees, how do you keep your staff? How do you stop people maybe from, you know, looking outside and seeing, you know, maybe is the grass greener? So there's a number of ways of doing this. So obviously, you know, your induction process, actually from the very beginning, when somebody starts with your company, your induction is key. You know, they always say, you know, first impressions last, and it's so true, and that applies to the workplace also. So, you know, the type of induction that you give your employees, that they know what's expected of them, they're shown the ropes, and that they feel, you know, valued straight away is really important. And also training. Again, you know, once an employee sees that they're being invested in, and that, you know, potentially that there's room for them to progress within the organization, that will keep somebody engaged and motivated in a company, because they feel that, again, that their employer cares and that they can contribute something to the organization. Work-life balance is something that obviously I've touched on already. This again is something that's really, really important, whether it's, you know, maybe a reduction in a commute, you know, being able to maybe pick up kids for after school, or maybe just even something like, it could be, you know, being able to attend, you know, your hurling or your soccer training or whatever after work, because you now have eliminated that long commute. Internal company communication, again, you know, I emphasized that in the last slide. That's really, really important, that, you know, people's expectations and the company's expectations are clear, that people know what's happening and feel involved, and, you know, feel that the company is listening to them. Employee assistance programs, these can be really good. I think particularly at the moment, you know, people have maybe some types of anxieties, maybe, or concerns with regards to returning to the workplace. So by offering your employees an employee assistance program, you know, that can eliminate any issues around that. Again, then flexible working hours, there's various different ones on this, and I'll go into that in a bit more detail in later slides. That could be different things. It could be flexi time, you know, start between certain hours, finish between certain hours. Could be a 4-day week. And obviously there's a number of companies in Ireland at the moment trialing that. Could be an early finish Friday. And it can be, you know, smaller initiatives like this that can really, you know, cause an employee to stay with you because, you know, they feel valued, it suits their lifestyle, and it stops them from thinking the grass is greener elsewhere. Employee wellbeing initiatives then, again, these are nice things to do for employees. Again, you know, over the pandemic when a lot of people were working from home, different things like, you know, coffee mornings or maybe little packages in the post, you know, just like could be a coffee mug and, you know, so a muffin or something like that. But there's small things, you know, they don't have to be extremely expensive, just things that, again, that get employees together, create that sense of well-being and purpose and belonging. Ourselves here in Matrix, we recently did a charity fundraiser for Down Syndrome Ireland, where we all had to do 100 kilometers in 21 days. And again, you know, we had a WhatsApp group and we were texting into it and sharing photos and stuff like that. And it was really nice for us all to connect over lockdown. Then additional benefits, you know, like your pension, health insurance, debt and service. Salary reviews. This is something that probably should be incorporated, you know, on an annual basis. It doesn't mean that you have to give a salary increase every year, but again, it's that you're sitting down with your employees, you're chatting to them, you're finding out, you know, what their expectations are, and, you know, then depending maybe on performance and on company's performance, then a salary increase may be something that is required. Again, positive performance management. Again, this is really important that you're constantly, you know, giving performance evaluation to your employees. Again, that they know where they're at, they know, you know, if they're performing well, if there's areas for improvement, and that this is done on a 360 sort of basis, so that they are giving how they feel they're doing and you're giving how you feel they're doing, and that, you know, you're discussing this rather than, you know, sort of the old school way of maybe just an annual performance review where the manager says, right, this is it, yeah, you're not doing well on this or whatever, and the employee leaves feeling really bad about themselves and they didn't maybe get a chance to state their side, or where they thought they were doing well, or maybe where they felt they were struggling a bit, maybe required more training. So again, it could be something like quarterly reviews where you've a quick sit down with your manager, chat about how you're getting on, and then, you know, a larger annual review at the end of the year. But it's the constant feedback that employees, you know, they like it and they require it. Training of managers. Again, sometimes people can be promoted into the area of manager because they're really good at their job. Doesn't necessarily mean that they're really good at managing. So again, that managers are trained, they know how to manage staff, they know what motivates staff, and they can bring people on board and get people to come along with them. Again, people who can see that there is opportunity for them to advance, and that sort of links into the training, that they're being invested in, that there's room for progression within the organization, and that there's a clear maybe career path for them. That's not always possible. Sometimes in SMEs, you know, that there's not that huge kind of, you know, structure to move up towards, but maybe there's additional, maybe there's like lateral moves that they can make where they can take on extra responsibilities in a different way. Maybe there's a project or something that they could become involved in. Support then for further education. Again, if somebody, you know, wants to maybe do a higher diploma or, you know, upskill in a certain area because they're taking on increased responsibilities, that can be a really good motivator as well. And then the company values, that this isn't something that's stuck on a wall somewhere, but rather that it's something that is a day-to-day part of the business, that, you know, you put thought into your values, but also that, you know, you live your values and they come from the top. And there's no point in having stuff up on the wall saying, oh, these are our company values, if the management team aren't displaying those values. And the values really should be part of the performance management. You know, when you're sitting down with your employees, you should be chatting to them about them and, you know, making sure that they're being lived by everybody in the company. So your remuneration packages then, so your traditional packages, your basic salary, maybe bonus and pension. However, as I was discussing earlier, people now are looking for more, and, you know, there's different elements that you can add on to that. So that could be, you know, debt and service benefit, permanent health insurance, Christmas vouchers, extra annual leave, support for further study, your hybrid working, your flexible hours. There's an organisation actually in, I think they're based in Northern Ireland. I think it's in Belfast, Fintru, I think they're called. I could be wrong on that, but they recently have given their workers, if you're there over 5 years, you actually get a 4-week paid sabbatical. So that's something they're offering their employees. Now, I'm not suggesting that you all go do that, but it's just something to bear in mind that these types of benefits really are valued by people at the moment. So what does the future of work look like? This is a really good question, because I suppose it's something that we're all wondering at the moment. I don't think there's any, clear picture of it. I think it's something that's, going to evolve over the next number of months. I guess we've all gone through a huge amount of change in the last 18 months, but the change probably, is not ending now that we're all, able to go back into the workplace. I think it's going to evolve as we go. Obviously, there are some roles that have to be done on site in the workplace. If you're involved in manufacturing, you have to be on site, and that is the nature of that role. Obviously, then there are other roles that can be done fully remote. So, we've all been sort of pushed into looking at these other options in the last 18 months. So it's, how does this look? Can the job be done from home? So this, I suppose, 9 to 5, Monday to Friday in the office, that's gone. That's no longer, I suppose that the must-have for employers and for employees. Equally, fully remote may not be something that's suitable for most roles, and from a number of surveys, it's showing that people want the mix of that. So you're looking at your hybrid model, where you're spending some time working from home and some time in the office. And when you're in the office, that's when you do your meetings, your brainstorming, all of that side of things. And then your solo work, you're doing that when you're at home. So great changes are afoot. So what is this? What does working from home mean for employers? How is it going to impact employers? What are the costs involved in that? So potential costs could be things like IT equipment. So your employees are going to need IT equipment maybe at home and also in the office. Security, do you need to put in additional firewalls? How much is that going to cost? Training, is there going to be some element of training there, particularly for new starters? How are you going to manage around that? Obviously then they're going to need phone, broadband, health and safety issues then, around that, what sort of health and safety training, because you are still, responsible for your employee while they're working from home. So that there could be some costs around that. Your potential savings then could be, office rent. Maybe you don't need that huge office space. If your workers are only coming in 2-3 days a week, maybe, they can rotate, and you might be able to downgrade to a smaller office space, or maybe you just need a space for meetings, once or twice a week. Your overheads again, your heat, your light again, phone, all those kind of things, they'll be reduced in the office. Travel expenses, people are doing more online meetings, not as many, traveling to meetings. Maybe your staff are going to stay with you longer because this really suits them. They really like this work. They don't want to move to another company, or maybe they are going to be expected to be in 5 days a week. So there's all of those sort of potential savings that can be looked at as well. So health and safety. So when you're working at home, that is the workplace. So your employer is responsible for health and safety in the home working space. So really what you should do there then is you get your employees to conduct a risk assessment for their work from home space and make sure that it's suitable for them. Like obviously at the start in March 2020, people were working, sitting on their beds, sitting at kitchen tables, maybe, kids running around the place. It was, a needs must situation. But, now that, we are returning to the workplace, people should have a dedicated space, and it should be suitable. You need to look at the ergonomics. You need to make sure there's not trip hazards, that, there's correct lighting, and that there's a correct space for them to do their work. Again, people could be, logged on a lot. So again, you need to make sure that as in the office, people are taking their lunch breaks and stepping away from their screen from time to time. So what some companies are doing is that they're, asking employees to send in pictures of their office. You need then again to, update your remote working policies, your health and safety policies to incorporate this, and to train employees and managers how to manage around this working from home. You need to have regular contact with your teams. So again, that, people aren't feeling isolated or working in isolation, so that there is that collaboration and not that feeling of isolation when someone's work from home. So obviously, like something like this, like Zoom or Teams, is great for that. And having your teams, and maybe having things like your coffee mornings where people can have a chat. And also, I think I recently attended a webinar around, burnout and stuff like that, around working from home and hybrid models. And somebody made the point, that as employers and as managers, we should also maybe show a little bit of, maybe vulnerability isn't the right word really, but when talking to our teams, and because when people are in the office, they can vent, they can let off steam. But when people are on these sort of forums, maybe they feel it's all business. But there should be that kind of chat. Maybe someone saying, listen, I'm not having a great day. Actually, this has happened, or whatever. And having that dialogue that you would have if you were in the office, so that people don't feel that they're alone. So there's different elements to work, which I mentioned already. There's a hybrid blended model, there's fully remote, or there's fully in the office. So again, as I was saying, it's about creating that sense of belonging and culture. You need to look at things like productivity, trust. Do you trust your staff that they're doing their work when they're at home? Security issues. I suppose, that the whole HSE thing during the summer months kind of has caused it to be a major concern for people. Again, around data protection, the whole GDPR side of things, and then obviously health and safety. And then again, for your employees, if they are working remotely and other people are in the office, do they feel that, am I going to be overlooked now for a promotion because my boss can't see what I'm doing here? So again, it's looking at all of this, and this is why those communication channels need to be open, and people need to be able to come to their managers to discuss issues with their managers. So I suppose, I know Nikola had put in here a discussion point about, have all of you guys decided how you're going to progress with the new working model? Is hybrid something you guys are looking at? I suppose here in Matrix, we have started returning to the office. I myself returned to our Carlow office just this week, just on Monday. So I'm in 2 days, Monday, Tuesday, and I'm from home today and for the rest of the week. So that's something to consider. I suppose, what have you guys decided to do? So what we would like to offer is a 10% recruitment fee for all attendees until the end of November. If you do have any open positions in your business at the moment that you'd like us to consult with us on, we can provide advice, chat to you about, see how we work, what our process is, and if we can provide you with candidates. Obviously, there's only a fee if you do actually engage with a candidate that we provide. So I'd be more than happy to have a chat with any of you. You can contact us at carlo@matrixrecruitment.ie or on our Carlo phone number 059 9139 070. And we'd be more than happy to chat you through that. And listen, thanks so much for attending.
Thank you very much, Joanne. Very interesting, and it shows the value of ensuring everybody in the organisation is fully up to speed and everything. You were able to sub in there quite well for Nikola with a challenge with connecting her sound. Is there any questions for Joanne or Tony or James on anything that we've covered really in the session so far? I think people are going to be thinking, there's a lot of information to take away and really have a think about, and even have a look at, a lot of organizations will have made changes already, but there is those opportunities for further changes in that there as well.
Brian, will you have all the slides available to all our members?
Yes, we will. So we'll have slides available. We'll also have the recording from today's session will be shared across all the membership and hosted on our own website then as well. So you will be able to refer back to any of the details. And it's always handier to have it as a video, because sometimes you look at slides and you're trying to wonder what way things might add up on it. At least then you can add the commentary. You know, you've got those great little analogies that come in there, whether it's Tony, the way he was making the comparisons at the start to Jesus and current government, to Joanne coming in there quoting Mel Gibson. You know, so that's those little small things help you to remind a lot of, remember a lot of different aspects of it as well. But I don't think there's any, if anybody's any questions, I think everybody is.
Brian, could I put a general question to Joanne? Yeah. A tight labour market would be one where unemployment is down south of 5%, and we're a long way from there. So in pure crude numeric terms, this shouldn't be a tight labour market. But obviously, it's not like that at all, because there are shortages in lots of sectors. Like, what's your sense, Joanne, in terms of where the greatest shortages are, and what's causing them, and I suppose I put another way, where the surpluses are?
Yeah, good question. I suppose we are, like in Matrix, we specialize in, we recruit from both multinationals and SMEs. We recruit primarily then in the manufacturing, medical devices, pharma, food, engineering, that space. So, and we also have financial services sector. So we're seeing the shortage, I guess, really right across the board. Like, for example, a typical role that we get in kind of at this time of year in the Dublin area would be for a particular client of ours. They normally have a huge drive coming up to Christmas for warehouse and production operatives. And normally we will be absolutely inundated with CVs for that. Whereas, this year we're not seeing them at all. And then equally, I myself recruit on the quality lab engineering side of things. So these could be like process scientists or quality engineers. These roles are always in short supply here. But again, you're just noticing, it's so much tighter. You're not getting, you have your jobs advertised on the likes of, Irish Jobs or LinkedIn or wherever. You're not getting candidates applying. How we're sourcing our candidates, it's almost 95% us reaching out to passive candidates, whether they're on our database or, through our networks or LinkedIn or whatever. So we're trying to entice people to move. And trying to find these people to get them to consider a change.
Okay, thank you.
Thank you. I don't think I have anything else kind of to add in there. There's no other questions coming in. Just a second there. Just a note there. I know Nikola was saying she's having technical difficulties with sound. Thanks to John for presenting, and well done to Tony and James. Just before we wrap up, one or two quick things that we've got coming up. October 28th, I've got very limited spaces on this. Chamber Connects. We've ran this event in conjunction with the Southeast Chambers twice already, and it's like online dating is one way to put it. Networking opportunity for businesses between the 5 Southeast Chambers of Carlow, Kilkenny, Waterford, Dungarvan, and Wexford. And we've got another one coming up on the 28th of October. And this one's expanded further in that we're bringing the 5 Southeast Chambers together, and we're networking as well with companies from Cork. So if you are interested in joining us on that, 28th of October, please email me as soon as we come off of this, because I have got very limited spaces. And then I know, as I mentioned to Tony and we earlier on at the start, we've got a leadership and wellbeing skills program which is taking place on the 2nd and 9th of November. It's a 2-day program, so it's 9 a.m. till 2:30. It's €90 per person to take part. I suppose the money raised from hosting the program will be donated to our charity partner for the year, which is Delta Centre. Again, we've got some limited space on that, and it will be held in person, delivered by Reg Friddle in the Talbot Hotel. Otherwise, we look forward to seeing you perhaps on the 11th of November as well at the Carlow Business Awards, which we're hosting live simultaneously in 3 venues in Carlow. on that night. So it'll be coming live from the Woodford Dolman Hotel, Ballykeely House and Lord Bagnall. So for today, I want to big thanks to Tony, Harney, James, Nolan, Joanne Foley and Nikola as well for putting in a lot and for taking us through the budget and indeed looking at recruitment and retention that there as well. I do hope you got something from it. As I said, it will be online from later tomorrow. But if you do have any other questions at any stage, you can come back to me directly and I can connect you through to James, Tony or Joanne as well. But thank you very much and enjoy the rest of the day.